G'day and welcome to the Morgans Edward Street Weekly Wrap. Today's the 23rd of November and after a volatile week I'll pass you over to Tristan for his macro view.
Thanks Cameron. It's been another tough week on our market, with the Dow Jones falling 800 points over the course of the week. Under spotlight was the tech sector, which has been hit the hardest. Apple, Facebook, Amazon have all posted losses for the week, which also led the tech-heavy Nasdaq lower. In economic news, durable goods orders dropped 4% in October, and the University of Michigan's Consumer Sentiment Index fell to 97.5, missing Wall Street expectations. The banking sector led a rebound in European markets to close an otherwise subdued week. In commodities, oil rebounded from falls of 6% earlier in the week to close at $63.48 a barrel. Base metals firmed as key contracts on the London Metals Exchange came to expiry. Iron ore has been volatile but has ended the week flat. On our market, we've been led by the US lower over the week, trading at 5,700 points. This is well off the highs of 6,300 earlier in the year. In stock-specific news, Wesfarmers has demerged Coles, which is now trading under the ticker COL. Recently listed Viva Energy disappointed investors with a profit downgrade, dropping to $1.80 from a float price of $2.50. Telstra has again dropped under $3, trading at $2.97. In a tough market, let's turn to Cameron to hear what stock is the safe haven.
Thanks Tristan. The recent market weakness and volatility has provided an opportunity to gain exposure to the technology-centric Nasdaq. The best way in my view to gain exposure to this index is through BetaShares Nasdaq 100 ETF, which aims to track the performance of the Nasdaq index. The index provides investors with exposure to the 100 largest non-financial securities listed on the Nasdaq stock market by market capitalisation. 3 reasons to buy this exchange-traded fund. Firstly, this will provide diversified exposure to the world's most revolutionary companies, including Google, Apple, Amazon, Microsoft, Facebook, Netflix, and Tesla, all in a single trade. These are no longer just US exposed companies, but are global companies with an ever-expanding footprint. My second point is the strong outperformance relative to the Australian and global shares, which in my view is likely to continue over the medium to longer term. I believe these technology businesses have imposed themselves into our daily lives, and this will only expand further as technology advances. As new emerging businesses enter the top 100 listed companies based on market capitalisation, they'll form part of the portfolio. And my third and final point is the simplicity and cost effectiveness of buying the ETF. With a single trade, you can have exposure to 100 companies at a low management cost of only 0.48% per annum. Australian equity markets are significantly underweight technology stocks, and this is an opportunity to gain international exposure to the rapidly growing sector. Put simply, there is no perfect time to buy an index of this size, and therefore I'm using the current weakness to accumulate exposure. The ongoing weakness could certainly unwind further, as the severity of the recent drop has surprised me. However, I'm using this as a chance to chip away and build a position taking a longer term view. Thanks Tristan.
Thanks Cameron. That wraps up another week. Please remember that our comments in the video are general in nature, and please speak to your Edward Street advisor if you wish to know if any of the stock recommendations suit your personal needs and objectives. See you next week.